When you put your money in the bank in something like a savings account, it doesn't just stay there waiting. The bank will actually take the money you entrusted with them and will give it away to other people in things called loans. Loans are the real way banks make money. When someone takes a loan from the bank, they agree to pay back the money over a long period of time, sometimes over more than 40 years. When you pay back the loan, you give the bank more money than what you took in the first place in interest, and so the bank makes money. This profit is split between the bank and you, the people who actually gave the bank this money in the first place. Although you don't really get very much, and it's only a percentage of how much you actually have in the bank. That might sound a little bit complicated, but basically what this means is when you have money in the bank, you're making free money without doing anything at all. More than just earning free money, banks provide you with all the security the federal government can provide. Even if your bank does go out of business or gets cleaned out by thieves, it doesn't matter. Your money will always be there thanks to the FDIC, or the Federal Deposit Insurance Corporation, a government program that insures all bank accounts up to $250,000. They were founded in 1933 as a result of the Great Depression, a time when people lost trust in the banks and couldn't get their money back. In response, the federal government initiated the FDIC so that if, for some unforeseen reason, the banks fail, the government will back the people. In addition to their added security, taking out loans and being vigilant in repaying them allows you to build credit at a bank, a topic that will be more thoroughly discussed in a later video. To put your money in the bank, first contact the bank you want to use. They are your biggest resource and will help you start your new account. To begin, you're going to need a few things first, like your driver's license, proof of your current address like a utility bill, and your social security number. Most banks have minimums for accounts, so when you open one, have some money on hand and call the bank before to ensure the minimum number and anything else you might need. So why does any of this matter at all? Well, most people understand that they should be saving, but they find it difficult to do so. This information aims to eliminate the major problems many people have. Just putting your money in the bank is really crucial. Recently, a woman in St. Paul distrusted the banks and decided to instead save her money in gold bars. A thief found her stash, and all of a sudden she was out more than $200,000, with no guarantee that it would ever be recovered. Had she kept this money in a bank, it would have been much more difficult to steal, and even if it was stolen somehow, the FDIC would have insured it anyway. In addition to the extra security banks provide, the chance to improve your credit score with your bank is also vitally important. Having a good credit score allows you greater access to the financial world, with the ability to take out mortgages and build lines of credit. More than that, banks allow you to earn money off of interest in savings accounts. All of these advantages offered by banks are critically important to building a secure future.